In this video, we will discuss the secondary market for financial securities, especially stocks. The stock market is a form of a secondary market. A secondary market is a marketplace where people can purchase goods from other people rather than from the original manufacturers or issuers directly. Suppose that you bought tickets to a concert at a concert venue and you bought it from their ticket office. You got the ticket. Here's your ticket. Looks like a puzzle piece, but let's say you wanted to see a concert. What happens? They sell you the ticket and you give them your money, and now you own the ticket. So the secondary market is a place where people can purchase goods from other people rather than from the original manufacturers or issuers directly. Suppose you purchase tickets to a sporting event from the official box office at the stadium. The venue or team earns revenue from the ticket sale. Suppose, though, that for whatever reason you couldn't attend the event, and instead of letting them expire worthless, you decided that you would sell them to your friend. Now your friend has the tickets and you've received the money. This is a secondary transaction. The venue doesn't receive any revenue whatsoever from this transaction, but you do. Even better if you were able to get more than you paid. So the same type of thing happens in the stock market. The only time a company actually makes money in the stock market is when it is selling its own shares directly, which typically happens through an IPO. All subsequent trading of the company stock occurs between two independent investors, where one investor is selling a stock and the other investor is buying it. So let's talk about the different types of market participants in a typical stock exchange. Note that I'll be using market terminology here. Bids refer to the price at which someone is willing to buy a stock, and offers refer to the price at which someone is willing to sell. I will definitely discuss these concepts in depth in another video. So there are two types of investors: the institutional investor and the retail investor, also known as the individual investor. These retail investors are typically individual people like you or me looking to buy or sell stock. Institutional investors usually include teams of professional investors, like those who work at hedge funds or at pension funds or mutual funds. They manage large amounts of money which they receive from other investors, and typically they are fairly sophisticated and will often rely on what's known as fundamental analysis for determining stock investments. That is, they research the financial statements of a company and they look at the data regarding the company's industry and or sector health. Both retail and institutional investors rely on brokers to facilitate their orders. The investor contacts their broker and the broker attempts to execute the order by asking market makers for bids and offers on that stock. Broker is basically an agent who is working on your behalf, and typically you'll pay that agent in the form of a commission. Market makers are effectively middlemen. They stand ready to buy or sell a security in order to maintain market liquidity. In the case of financial securities, by the way, liquidity generally refers to the volume of transactions in that security. A liquid stock is one that trades more frequently. The same is true of any security. A liquid security is one that trades more frequently. Liquidity is a very, very important concept, and we will definitely go in further depth in another video. But suffice it to say, the market maker works to facilitate liquidity by maintaining their bids and offers as orders come in. Once they've bought or sold stock, they quickly offset that order by using either their own inventory of stock or by entering into an opposite order. So for example, if the original transaction is a buy, then this is the investor, here's the broker, and the broker talks to the market. Here's a market maker, MM for market maker, sold. And at the same time, the same guy or girl is buying from another broker who receives his order to sell from another investor. This is a broker, also a broker. So if the original transaction is a buy, they'll sell. If the original transaction involves a sale, they will buy to offset. The process is very quick and often only a few seconds long. It can happen hundreds of times in a day.